Hello, hello. Can you guys hear me on Zoom now? Okay, sorry about that. The mic was switched off from something else. Okay, all right. And so basically, so I think the only important thing the Zoom people you guys missed was I'm going to be putting up the first homework assignment, the first real homework assignment, probably sometime this afternoon, and it's going to be due not next Tuesday, but the Tuesday after that. Okay, and so are there any questions I can answer before we get started for today? Okay, all right. So let's go ahead and get started. Okay, and so today is kind of the introduction to, kind of the more formal introduction to this class. And so the lecture notes that I have there it's called Time Value of Money. And so there's kind of a lot to do in this, in this lecture notes. But let's start off with the section called Engineering Economics. By the way, I know my handwriting could be a little bit hard to read on the iPad, so anytime you don't understand what I've written down, just let me know. I'm always happy to rewrite. Okay. Okay, so like we talked about on Tuesday, EGME 4.1 is a little bit unique, where I would say basically all your other engineering courses you take here in this department are what I call technical courses. Okay. Okay. And what I mean by that is that you're learning technical information, right? So you're learning about Newton's laws, you're learning about science, all the stuff that you apply, and that's kind of what makes engineering unique, right? And so as engineers, we apply basically these math and science principles to come up with devices or come up with technologies to better humankind, or at least that's what we like to tell ourselves, right? And so this class is different, and so we're not going to be covering any new technical information, right? And so if I had to sum up this class in a couple of words, I would say this class is more about decision making and resource management. Okay? Okay. And so hopefully you guys got a little taste of that on Tuesday with our activity. Okay. And so these are just as important, or sometimes even more important, than the technical aspects of your project. Okay. And oftentimes these are kind of the driving forces as to what drives companies to either engage with the project or to drop out from project or other things. Okay. And of course, when I say resources, I mean, primarily most of the time I mean money, but resources could also be time, it could be personnel, it can be a lot of those different things. Okay? Okay. All right, and so as we go through this class, I want you guys to kind of assume the role of an engineering manager. Okay. And it's kind of a good time for that too, because what we're seeing a lot now in the industry is that a lot of the management positions at these engineering companies are being taken up by engineers like us, right? And so that's great. And so I think in the past, what's happened before is that a lot of these management positions have gone to people that are kind of more business oriented, and they may not understand the technical aspects of the engineering projects. But nowadays, a lot of the engineers, at least the ones that we're training in the universities, are coming out with some training in economics and ethics and things like that, where they can take on these roles, right? And that's generally good for the company, and that's good for the projects in general, so that you can bring that technical knowledge, but also bring, this business sense as well. Okay. And so what we're seeing more and more nowadays is that, there's kind of an expectation that engineers that come out into the workforce have basic understandings of economics and business sense, so that they can take up these roles. Okay. Okay. And so this class is aimed at kind of giving you guys that knowledge set, that skill set to be able to do this. Okay. All right. But with that said, I think for a lot of us here, at least I know when I took this class too, back in college, this was kind of my first experience with economics. And so we're going to start with kind of the basic of the basics, right? And so I think some of what we're going to cover today, you might be like, yeah, of course, that's like, what is a cost, right? A cost, we all deal with costs every day. But to kind of start any kind of a new journey like this, we kind of have to start at kind of the bottom and kind of work our way up. Okay. Okay, so let's start with just some very basic definitions. Okay, so the first one is cost. All right, so cost, the way we're going to define it is that money that you put out, or it's a loss of money for. Okay. Okay. And we represent cost as basically just a loss of money, or like a negative thing, right? And so when you go to pay your credit card bills every month, you withdraw money from your bank account. That's a cost for you, right? Okay. So from an engineering business point of view, usually when we incur a cost, this is usually when we're purchasing something. Okay? Okay. And so that something could be anywhere from pieces of new equipment. It could be raw materials. It could be labor. It could be basically anything. So any money that you pay out, we'll consider it as a cost. Okay? We're also going to be talking a lot in this class about investments. Okay. And so usually when you make an investment in something, you pay an initial cost, and that's going to generate money for you over time. At around this time last year, investments was very hot because crypto was booming and stock market was booming, but now no one wants to make investments because everything is down and everyone's sad they've made investments. But that's a story for another day. Okay? Or one specific instance that we'll see a lot is that usually when you make a large purchase of a piece of equipment, for an engineering project, you have to perform maintenance on it. And so what we'll see in lot is that, one very common cost that's associated with engineering projects is factoring in these recurring maintenance costs. Okay. So I think those are probably the three most common cases we'll see in this class, but of course, you can spend your money on almost anything. Okay. All right, number two. And so the opposite of cost, we'll call it a benefit. Okay. All right, so unlike a cost, money, a benefit is money that comes into your account, right? Okay. And we often represent this as a gain. And so within the context of engineering economics, this most commonly occurs when you make a sale of your product. Okay. Okay. Or for some cases, the sale of a service. Okay. Or oftentimes, this could be, money that you gain from an investment as well. Okay. 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 So those are our two kind of very basic definitions to start working. So when we're talking about money, oftentimes we're talking about money that's moving around. And so, money that's being lost by you, we call it a cost, and money that's coming into you, that gets paid to you, we call that benefit. Okay. All right. And so in general, for most engineering projects, the aim is to have the benefits exceed the costs. Right? Or excuse me, higher benefits than you want to make. Okay. And so in other words, we want our engineering projects to be profitable. Okay. Right. Right. So that makes sense because, most engineering projects, just by the nature of how many resources they require, they're undertaken by companies. And for a company to stay afloat, they have to make money. And so the projects that you do have to be profitable. It's a very, very basic thing. Okay. Any questions on this so far? Okay. All right, so let's break this down a bit. And so let's talk about some costs, and let's talk about the different kinds of costs. Okay. All right, and so there's lots of different types of costs, and we have labels for a lot of these. Okay. And so the first type of cost that we'll say is what's called a fixed cost. Okay. And so fixed cost is a cost that has a constant value that does not change based on the level of output or activity. Okay. Okay. And so what do I mean by that? And so a lot of times, you know, in order to produce certain products or to produce certain services, you know, the more of that stuff or the more product that you produce, the costs are going to increase. Fixed costs are not like that. And so, you know, the most common case of a fixed cost that you'll see are pieces of equipment. Okay. Okay. All right. So very simple example of this is that, you know, say that you are, you know, you sell scrambled eggs as a business, right? And so a fixed cost for you would be your frying pan, right? And so you buy your frying pan once, it's a fixed cost, and you can make, you know, as many, it doesn't matter how many scrambled eggs that you make. The frying pan, you just buy it once, okay? All right. And so the opposite of a fixed cost is a variable cost. Okay. So a variable cost is a cost that does change in value based on the amount of output. Okay. And so the more output that you produce or the more products you produce, you know, variable costs are going to go up, right? And so, you know, the most common case for this is going to be raw materials. Or I think nowadays what's more relevant is power costs, right? And so the longer you keep your machine running, you know, your electricity bill is going to go higher. Right? Going back to our scrambled egg business, right? A variable cost would be the cost of eggs, right? And so the more scrambled eggs you produce, you need to buy more eggs. Okay? And so when I say egg cost, I don't mean that the cost of each individual egg goes up, but the overall cost that you spend on eggs, you know, you say you buy 500 eggs versus 400 eggs, you know, 500 eggs are going to cost more because, you know, there's more. Okay. Let's stick with, let's do one more definition, actually. This one. Okay. And so the third type of cost, so a little bit unrelated to the first two. So the first two are kind of opposites of each other. The third one is a term that you'll hear probably a lot in the business sense, and that's marginal cost. Because a lot of times when you're talking about cost, you're talking about, you know, the overall cost to produce just one unit of product, right? And so the marginal cost is the value or the cost required to produce one more unit of output. Okay. Right, and so if you hear the word marginal cost, that's kind of what it means. Okay. All right, so we've done a lot of definitions here, and so hopefully a lot of them are fairly straightforward. But let's do an example here, just to kind of blend, just to kind of put some reality to a lot of these things. So before I do that example, are there any questions so far? Okay. All right, so let's do an example. All right, and so let's say that you are part of a club here on campus, and you are responsible for planning a banquet for your club. Okay. Okay. All right, and so you're responsible for making sure that that your club doesn't go broke when planning this banquet. Okay. All right, and so you're starting to talk to vendors, and you're trying to see how much is everything's going to cost, right? And so the first thing that you look at is to rent a venue or rent a room. Okay? Right. And so what you find out is that the place that you want to book has a rental fee of $225. After you rent the room, the next thing you're looking at is food. Okay? And so you contact some catering services. Okay? And what the catering service tells you is that they will charge you $20 per guest that you have. Okay? Okay. And so for each guest that RSVPs that plans to come, the catering service is going to say that's going to cost us more materials, more labor to produce extra food. And so they're going to charge you based on the number of guests. Okay. All right, and then finally, I know, for those of you who plan these things, I know there's a lot more involved in this, but this is just a simple example. And so what your club president says that, the most that we can charge people to come to this banquet is $35. Okay. So that's money that the club is going to get from each guest. Okay. Okay. And so we can do a couple of things with this. And so first of all, we're gonna look at all of these money values here. We're going to characterize them as either a cost or benefit, and then what type of cost it's going to be. Okay. Okay. And number two, your club wants to determine, based on these numbers right here, how many guests need to come before the cost kind of break even. Okay. Okay. All right. So let's go ahead and characterize these quantities, and let's take it from the perspective of the club, right? Because usually whenever you pay money out, there's always a recipient, and there's also a person that's paying it out. And so your perspective is important. So the perspective we're going to take here is the one of the club. Okay, so let's start with the room rental. And so the room rental is a $225, or that's money that you're going to pay to the venue, right? So obviously this is going to be a cost. Okay. And here, it's not output or product in a traditional sense, but our cost is being that or cost is being tabulated in terms of the number of guests, right? But the room rental here, it doesn't really matter how many guests we bring. It's just, we're renting out space. And so for that reason, the room rental here is going to be considered a fixed cost. Okay. All right, so now the catering. And so the catering is $20 per guest. And so that's also going to be a cost, right? Because that's something the club is going to be paying out. But because the total amount of money that we're going to pay to the catering service depends on how many guests we have, this is going to be a variable cost. Okay. All right, finally, we have the entrance fee. And so this is money that each guest is going to pay to the club. And so since this is the money that the club is gaining, we're going to call this a benefit. Okay. All right. So now let's tackle part 2 of this problem. So part 2 is asking, how many guests do we need in order to break even? Okay. And so for break even basically means that the total amount of costs, that you're incurring is equal to the total amount of benefits, right? And so let's use our, our money flows up above to characterize these. So let's do the total cost first. And so the total cost, first we have our fixed cost, and so we have a fixed cost of $225. Okay. Then we have a variable cost, and so our variable cost here is going to be $20 per guest. But right now the number of guests that we have is unknown, right? So that's what we're trying to determine. And so let's use the variable for the number of guests. And so I'm going to use the variable X. Okay. X right here. Okay. X right here is the number of guests, which is unknown at this point. Okay. And then the total amount of benefits that we're going to receive also depends on the number of guests. But instead of being 20x, we're going to be 35x. Okay. Okay. And so you can see here we have a very simple algebraic equation. And so we're going to subtract 20x from both sides. It's been 2 years and I still don't know why my iPad does that when I write sometimes. All right, so we have 225, 35 minus 20 is 15. Okay. And so if we solve for x is equal to 225 divided by 15. 225 divided by 15 is 15. Okay. And so in order for the club to break even for this banquet, at least 15 people need to come out. Okay. Or should I say 15 guests. All right. Any questions on this example? Very straightforward, I think. Right? I wrote this example from personal experience because I've planned these before, and oftentimes we did not meet that not meet that, and I had to answer some questions to our treasurer for some good reasons. Okay, so that's kind of just the basics of costs and benefits. So now let's talk about cash flow diagrams. Okay. All right, and so the past example that we did, was fairly straightforward, right? We could kind of list out all of the costs and benefits just kind of in a list, and then just kind of know intuitively what to do with them. But as you can imagine, for much larger engineering projects, the number of costs, the number of benefits, it's going to be very, very large. Okay. And so keeping track of all those costs and benefits can be a challenge, right? And so making sure that you have everything, and you kind of have a good idea of where everything is going, right? So that can be challenging. And so for this reason, it can be helpful to have kind of a visual way to organize all that information, just so you can kind of know, just so you can kind of see at a glance, what the economic picture of your project looks like. And so that's the idea for a cash flow diagram. So cash flow diagram is a way to kind of visually see or visualize all the costs and benefits associated with the project. Okay. And this is especially important for a lot of engineering projects, which often take a long periods of time, right? So oftentimes when you undertake a project, it takes place over the course of several months, sometimes even several years, right? And so it's important to be able to visualize, what are the costs, when are they going to happen at specific times, and if you have enough benefits or enough money coming in to cover all of those costs. Okay. All right. And so I'll draw some examples in a second, but just to kind of give you a quick preview, cash flow diagrams are basically what I call a segmented timeline. Okay? Okay. And so the timeline is used to represent what's going to occur over a period of time, and we use arrows to indicate different cash flows. Okay. Okay. All right, so I'm going to draw an example here with just some made up numbers. Okay. And so here is our timeline here. Okay. Right, so cash flow diagrams always start at year 0. And so 0 is always going to be your first one here. Okay. And then each segment is numbered sequentially after that. Okay. All right, and so the way these work is that if you want to represent a cost on a cash flow diagram, you want to draw an arrow down. Okay. Okay. And so let's say that this arrow here represents, let's say it represents $1,000. Okay. And if you're good at this, I'm not as good. Then you can do you can adjust the size of the arrows to indicate different magnitudes of money, right? So let's say that initial cost is $1,000, and then we have other costs that are smaller over time, and let's say that these are like maintenance costs, right? And so let's say that each year here, year 1, year 2, year 3, year 4, year 5, we're paying a maintenance cost of $200. Okay. Okay, and so on the flip side, a benefit that this engineering project is going to bring in is going to be represented as an up arrow, right? And so let's say that each one here, is going to be $600. Okay. You don't have to have the colors. I'm only doing the colors for now just to just to kind of better illustrate it. But most of these you'll just see and they're just one color. Okay. Okay, so let's go ahead and break this down a bit. Okay. All right, so let's talk about the segments first. And so each segment So each segment on this cash flow diagram here represents a period of time. Okay. Right, so most of the time, those numbers, what they mean are years, right? So separating 0 and 1 and 1 and 2, usually that may be 1 year of time. Another common one is months, okay? And so each segment there might represent a month, or sometimes even weeks, right? So it depends on kind of how much granularity you want in your cash flow diagrams. Okay? And I mentioned just previously that year 0 or time 0 is always the first part that you draw. Okay? And time 0 is a very special time, because what time 0 represents is the time period of today. Okay? Okay. Okay. And so that's important because when you draw cash flow diagrams like this, you can see that they're always talking about the future, right? And so you almost never draw a cash flow diagram for something that's already happened. You use cash flow diagrams to plan out, a project that's going to happen in the future. Okay? Okay. All right. And so what that also means that anytime that you see a cash flow on time zero, that's most of the time it's going to be a cost. And so most of the time that's going to be a cost that you're going to pay out right now. Right? And so as a very simple example, let's say that this cash flow diagram here represents the kind of the project life cycle of some kind of manufacturing machine, right? And so when you purchase a new machine, you have to pay the initial cost for the machine, right? So you have to go pay that $1,000 to buy the machine, right? And then each, let's say that each time period here represents a week. Each week, then that machine is going to produce products that you can sell, maybe for $600 per week. But in addition to that, you're going to need to buy $200 of materials every week. Or maybe there's some maintenance costs in there as well. Or maybe you got to pay the guy that runs the machine. And another thing that's important for cash flow diagrams is that we always assume that the cash flows occur at the segments. Right? Okay. And so going back to our example of this representing machine, of course, the products that you sell from the machine, all those sales are going to take place, during the week, right? And so I think what a lot of people do when they first start doing this is they say that, all right, on Monday I made, this amount of sales. On Tuesday I made this amount of sales. Wednesday, Thursday, Friday, and so on and so forth, right? Once you start drawing arrows in the middles of the time periods like this, it makes the calculations that we're going to do later a lot more complicated. And so just to make things simple, we just kind of lump everything together at the end of the time period. Okay. And so, this $600 here, this represents all the sales that we did for this entire week. And we kind of just lump it together at least. And that's kind of just for simplicity's sake. Okay. If you do feel like you need more granularity in your cash flow diagrams, let's say that you need to break it down, maybe you need to break it down day by day, then you would instead change the diagram so that the segments represent days instead of but yeah, oftentimes you're never going to draw arrows in between. And as we start to do calculations in a bit, that's going to be clear. All right. Any questions on cash flow diagrams here? Okay. All right. So let's dive further into cash flow diagrams. And so in terms of how do we use these to organize an engineering project. Okay? And so in a lot of engineering projects, a lot of these kind of follow a similar pattern. Okay? And oftentimes, the different parts of this pattern, we give them specific names just to kind of make it easier to refer to them. Okay. All right. And so we're gonna have more definitions here. And so I know lots of definitions today. All right. And so the first one we're going to talk about is the initial cost. Okay. And so initial costs, these are the expenses that's required to start an engineering project. Okay. Spell. Okay. And so just like the name implies, these are costs that are incurred at time zero on the cash flow diagram. Okay. Okay. And usually what the initial cost entails is the purchase of some kind of capital equipment, right? And so usually it's the cost to buy equipment, to install equipment, or to build it, right? Okay. And so almost always there's going to be some kind of initial cost because you got to buy some stuff to get the project off the ground. Okay. All right. And so another type of cash flow that you'll see commonly on a cash flow diagram are operating costs or maintenance costs. Okay. And so maintenance costs, these are recurring costs that occur throughout a project that are required to maintain your equipment. Okay. And so these are costs that occur usually at regular intervals, and so that's why we call them recurring costs. Okay. All right. So number three is called salvage value. Okay. And so the salvage value, this is a benefit, and this is a specific benefit that occurs at the end of a project life cycle. Okay. Okay. And what this represents is represents the money that you can recoup or to regain from selling your equipment. Okay. And so what can happen often is that you buy a very large piece of equipment, or maybe you buy, let's say you have a delivery service, you buy like a truck, right, to deliver your packages. And so let's say that your specific project has like a 10-year life cycle. And then at the end of that 10 years, you can either sell that truck off or you can sell its parts, right? And we call this the salvage value. If you put it another way, you can say that the equipment that you buy, it still has value even after you buy it. And so the salvage value can represent how much money that you would get for liquidating those assets. All right, so four is revenue. And so revenue is a recurring benefit that occurs from the regular sale of a product or service. Okay. Okay. And number five, the other most common type is what's called an overhaul cost. And so overhaul costs, these are major costs that occur during a project life cycle that doesn't really fit into any of the other costs. Okay. And usually overhaul costs are just usually a 1 or 2 time thing. So it's not a recurring cost. Okay. So oftentimes what you'll see is that, the equipment that you buy, it'll have, a major maintenance that's required, maybe after 4 years of service. And so that would be characterized as an overhaul. Okay. All right, so let's do another example, just to kind of put some, kind of illustrate a lot of these concepts. But before we do that example, are there any questions on this? Okay. All right, so let's do another example. And so let's say that you are overseeing the construction of a wind turbine. Okay. Okay. And this wind turbine is going to be used to produce and sell energy. Right, so we can draw the wind turbine, and so let's say that if you've driven to Palm Springs or anything, you've probably seen them along the road. Okay. Okay. So it looks something like that. Get wind blowing at it. Okay. And so you guys know how these work. So wind blows at the wind turbine, it's going to cause it to rotate, and then that rotational energy is turned into power. So when I was making these notes for the first time, and my wife looked over my shoulder, she's like, "That's a cute flower you're drawing. Like, what are you drawing a flower for?" I'm like, "It's a wind turbine." And she's like, "It's a cute wind turbine." She's I mean, she does graphic design, so she never misses an opportunity to make fun of my drawings. Okay. All right. And so let's go ahead and start talking about the cost. And so to build this wind turbine had an initial cost of $80,000 to construct it and to install it. Okay. In addition to this, we're going to need to maintain the wind turbine, and so it's going to have a maintenance cost of $9,000 per year. All right, and so based on estimates and kind of based on the wind patterns in the area where it's being built, what you've been able to estimate is that each year it's going to produce about $24,000 worth of power that you're going to sell off. Okay. Okay. And then We also have a salvage value. Okay. And so the wind turbine is not going to last forever. And so it only has a limited life cycle. And so let's say that at the end of year 6, and so let's say this, this is only going to last 6 years. After 6 years, you can sell the parts for this wind turbine for $10,000. Okay. All right. Okay, and so those are all the different cash flows that are associated with this problem. Okay, and so we're going to do 2 things. And so first of all, based on all of these different cash flows here, we're going to draw the cash flow diagram. Okay. I've already went ahead and labeled all the different cash flows for you. So for this example, I kind of already labeled everything, but usually the way that these problems go is that you're going to read kind of like a word problem or like a word description of the project. And it's going to be up to you to characterize, what's the initial cost, what's the maintenance cost, what's the revenue. So just kind of keep that okay. So it's not always going to be spelled out pretty nicely. All right, and so in step 2, after we draw the cash flow diagram, we can draw what's called a cash flow table. Okay. So cash flow table, we haven't talked about it yet just because it's, once you draw the diagram, it's pretty straightforward. Some people prefer kind of a tabular view of this information, and so that's kind of what the table is for. Okay. All right, so let's draw the cash flow diagram. All right, so based on the information that we see here, the first thing that should jump out at you is that we have a 6-year life cycle, right? And so our cash flow diagram should go up to year 6. Okay. Right, so let's go ahead and draw our line here. Remember, we're going to start at 0, right? So all cash flow diagrams start at 0, and then we're going to draw 6 segments. Right? And so the last one's going to be 6. Let's see if I space these out well. 2, 3, 4, 5. Close enough. I think they're equally spaced. My wife's been having me hang up pictures in our house lately, and then I've had to redo so many of them because they're not level, they're not straight, they're not lined up, they're not spaced well. So I'm a little bit on edge for those things, but I think I did a pretty good job with this. Right? Okay. And so now that we have the time segments for this cash flow diagram, let's go ahead and start putting in some of the numbers. Right? So first thing we have is the initial cost. Remember, initial cost is only a cost that occurs at time 0. Right? Okay, and so we're going to draw a very large down arrow there. Okay. And our initial cost in this case was $80,000. Right, most cash flow diagrams you draw are gonna have that because that's the cost to get the project off the ground. All right, so after the initial cost, we have the maintenance costs. Remember, maintenance costs are costs that occur every year. Okay? The important thing about maintenance is that they don't occur on year 0. If someone's trying to maintain your equipment as soon as after you buy it, you're probably getting scammed, and so watch out for that. And so usually for maintenance costs, they're going to start to occur on the first year and then every year after that. Okay. And so we're going to, let me use a different color for that. Okay. And so our $9,000 a year maintenance is going to start on year 1, and it's going to go each year after that. In orange here, we have maintenance. You don't normally have to label it as clearly as I'm doing it. This is just kind of a first time. Okay. Most of the time, you just have to put the arrows down there, and then that's it.
You still do a maintenance cost on the 6 years, so you're gonna salvage it, or you just
Yes, so remember, we lump all the costs from that period, so that,
throughout
exactly, yeah. Mhm. All right, so next, let's do the revenue. Okay, and so the revenue is $24,000 per year. And again, we're gonna lump those together at the end of the period. Okay. And so these represent revenue. Okay. And then finally, we have the overhaul cost. And so the overhaul cost, excuse me, the salvage value. And so the salvage value is, what that tells us is that at the end of 6 years, we're going to sell the parts for $10,000. And so, we're going to put another up arrow right here. Be $10,000. This is the salvage. Okay. And so that's kind of the basics of, how you go from like, the description of an engineering project to a cash flow. And so from here, it's a lot easier to visualize, right? So you can see here that we have a very large initial cost of 80,000. You can see how our maintenance costs are distributed, our revenue is distributed, and where the salvage value is at the end. Okay. All right. Any questions on how we drew this diagram here? Okay, so that's the cash flow diagram. Now let's draw the cash flow table. And so the cash flow table is going to show exactly the same information, just in tabular format. And tabular format, we're not going to do too much with it right now. But later on, we're gonna cover a unit on taxes. And for taxes, when you do taxes, it's a lot easier to have stuff in tabular format. Okay. And so, for a table, you can kind of break this up for as much or as little as you want. And so you can have definitely different columns for maintenance cost, revenue, salvage cost, or salvage values, things like that. But for this one, I'm just going to keep it really, really simple. And so I'm just going to have one column for the costs, total costs, one column for the benefits. Okay. And we're going to track these costs and benefits per year in the life cycle of the project. Okay. And so we're going to start at year 0, year 1, year 2, 3, 4, 5, 6. All right, so this column will be time right here. Okay, so let's start with time 0. So time 0, we have our initial cost, and so our initial cost is a negative $80,000. Okay. So that's how much we're paying on day 1 of the project, hour 1, minute 1. And during that time, we haven't made any money yet, and so the benefits are going to be nil. So we'll just put like a line there. Okay. And that matches up with our cash flow diagram, because on our cash flow diagram on year 0, we just have that single down arrow for the initial cost. Okay. So let's fill in the cost columns now. And so the only other costs that we have associated with this project are the maintenance costs. And so we're going to have a minus $9,000 each year. Okay. So that represents the maintenance costs we're going to pay throughout the life cycle of the project. Okay. And the benefits, first of all, we have our revenue. And so our revenue each year is going to be $24,000. Whoa. Okay. But remember, on year 6, we have the salvage value as well. So we're going to need to add that extra $10,000 there. Okay. And so if you want, you can combine this into one number. And so you can say this is 34,000. Okay. All right. And so this is just a simple, table that you can use to tabulate these things. And so again, we're not going to do too much with tables for now. They're more useful when we're doing taxes, but it's good to kind of see both kind of at the same time. All right. Any questions on this? Okay. All right. And so, we're almost out of time today, but I think this is a good time to kind of stop and ask ourselves, right? Remember what I said at the beginning? I said, usually when you undertake an engineering project for a company, the aim is for that project to be profitable, right? And so if we look at this cash flow table right here, would you be able to tell me if this project is profitable? Okay. And so I think what most people would do is they say that, to be profitable means the benefits have to outweigh the costs. And so I think what most people would do is that they take the benefits here, you would add them all up, okay? You get some kind of total benefits. Okay. That didn't work out as well as I thought, but it's okay. And then you would take all the costs associated with the with the project, you add them all up and you get some kind of total cost, right? Right. And then what you check is if the total benefits exceed the total cost, then your project is profitable, right? Easy. What I'm going to tell you is that it's not that simple in this case, right? And the reason it's not that simple is this. You're probably wondering, why did I circle that column there? That makes no sense, right? And so the thing that complicates, whether or not this project is profitable or not, is the fact that this project takes place over a long period of time. Okay. As most engineering projects tend to do. Most engineering projects don't just take place over a week. And so these are projects that are maintained. They're supported for, years, years at a time, right? And what complicates things is that, as large amounts of times pass, the value of the money that you put in and you take out, that's actually going to change. Okay. And so money that you have today, its value is going to be different than money that you might have in the future, right? And there's a lot of reasons why this is, right? And so I think the thing that's on everyone's mind right now is inflation, obviously is a thing, right? We won't talk about inflation yet. We will talk about it kind of near the end of the economics unit. But even just outside of inflation, there's reasons why the value of money will change. Okay? And so I'll introduce the idea just now, and then we'll kind of dive more into it on Tuesday. Okay, so this is called the time value of money. Okay. And so I'm going to start this section by asking you a question. Okay. maybe a fairly juvenile question. And so, you know, if you have the same high school experience as me and, you know, you were on long bus rides, you probably played Would You Rather with your friends. That involved maybe some things I can't repeat here. But we're gonna do a very simple Would You Rather, okay? All right, so I have a $100 bill in my pocket. I don't actually have that, but let's pretend that I do, okay? And so would you rather me give you that $100 right now? Or would you rather get that $100 1 year from now? Okay. It's the same $100, okay? And so if you choose option 2, I will literally put that $100 into a box. I will put it in my office, and then we will unlock it a year from now, and you can have that $100. Okay, the exact same $100 bill. And so, would most of you rather have the $100 now or a year from now? Now, right? So, because if you have it now, I mean, you could spend it on something now, and for a year from now, it's still going to be the same $100, right? And so the most practical case, or the most practical answer here, is to get that money right now. Okay. And the reason for that is that, you know, money that you have right now is always going to have more value to you than any money that you have in the future. Okay? Let me qualify that. So the money that you have now is worth more than the same amount of money in the future. Okay. Because first of all, I mean, you could spend it on something now. But you know, another way that you can look at it is you can take that $100 and you can invest it, right? Right? And then any money that you invest in something, whether it be in stocks or crypto or whatever, right? And so, you know, hopefully if you invest well, then the money that you invest is going to grow a year, right? And so let's say that you invest, just for purely theoretical sake, let's say that you take $100 and you invest it in a bank account that has an annual interest rate of 10%, right? And so what that means basically is that you keep your money in that bank account and the bank's going to pay you 10% on that money a year from now, right? And so if you took option 1 right here and you invested that $100, at the end of a year, you'll have $110, versus if you took option 2, you just have $100 because, you know, you waited. So that $100 that you waited on has less value then than it does right now. Okay, so we'll go ahead and stop here for today. Are there any final questions I can answer before we close up? All right. So that's all I got planned for today. And so we'll continue this on Tuesdays. We'll look at different examples of this and, you know, how this applies to engineering, and we'll go from there. Right. So have a great afternoon, everyone. Have a great weekend, and I'll see you guys all on Tuesday. You guys.
Yeah. think you'll take some time.
Yeah. It's no rush. I mean, take your time. You know, I don't want you to rush through it. You kind of really take your time. Like this. Yeah, it's no rush.
Yeah, I read it, chapter 1.
Okay,
Well, that was basically like how the hard move
yes.
go through and how it comes.
Yep.
I kind of get the idea.
Uh-huh.
I tried to read the second part, but I was really tired of this.
Oh, yeah, no, it's no, I mean, I know you're taking classes right now. So
Yeah.
It's no rush, just
Okay.
go at your pace, and then if you run into questions, just let me know. It'll be fine.
Alright. And I heard you're teaching 441.
Yes,
Mm-hmm.
yeah, biomechanics, yeah.
Yeah, biomechanics. I was gonna take the class out of region 3 so we can take the class.
Ah,
It
dang.
sounds really interesting. Do you have any plan to have the same class next semester?
So so it's a technical elective, and so those are only offered once per year. And so next time I offer that class, probably next year. But next semester, I often teach a class called 442, which is actually much more closely related to the collaborative stuff. Yeah, so it's called computational cardiovascular engineering. I think that's what I call it. So it's 442, so that'll be probably offered.
442 requires the 441.
No, it doesn't. They're different.
Okay, sounds good.
Yeah.
Thank you.
Yeah.
I'll read it as soon as possible.
All right. Hey.
Bye, Justin.
All right, bye guys. See
Yeah.
you guys.